Many of you have asked me about my opinion on AVGO stock. The stock is finally going down. It's down 13% over the last 5 days. I've never done a video on AVGO, so I'm very excited to talk about it and do a quick overview on this one. And I really hope you enjoy it. Now, the strange and unique story of AVGO is that the name Broadcom itself was an acquisition. The company has mainly grown through acquisition, which isn't really common with a lot of the semiconductor kind of stocks. They mainly grow organically or internally, and this one had a lot of growth via acquisitions, and they're really good at acquiring companies for the right price and integrating them and maximizing their value. And the latest one was VMware, which has so far been a massive success, and revenues have exploded after this acquisition. So this is a very unique story for AVGO. AVGO makes money in two different ways. The first one is the semiconductor solutions, a lot of things within the AI kind of chips and silicon-based chips, and they've had a huge success with that. The second one is infrastructure software, which was largely driven by the VMware acquisition. Then they get to revenues, $18 billion. They have a few expenses, and they end up with a 47% net income margin. Very efficient business and very high net income margin, which is really amazing. The company destroyed their latest earnings estimates, $1.95 versus $1.86. They also beat on revenue. It was a slight beat, nothing too crazy. The company expects their AI chip sales this quarter to double from a year earlier, and the AI chip segment is booming. They have a lot of customers, and they have a huge backlog of $162 billion, with $73 billion alone coming from the AI chips. They have OpenAI as a customer. They have Anthropic as a customer. They have Google as a customer, which has been having a massive success. And I believe some of Amazon's chips are also made by the AVGO AI chip segment. And the company has been riding a massive trend of those hyperscalers saving money by making their own chips with AVGO instead of buying the overpriced NVIDIA chips. They will always be buying the NVIDIA chips, but there are certain applications where they can save some money, design their own chips via AVGO, and they save money for it, and AVGO makes a lot of money, and it's a win-win for both sides. But $162 billion is huge. It's almost 3 times their current revenue of $63 billion, and this is absolutely amazing. They revealed their latest customer, which they were not talking about this one, but they recently revealed it, and that was Anthropic. Anthropic ordered $10 billion, an additional $11 billion. So $21 billion from Anthropic as of the recent quarter, and some analysts estimate that the custom chips from OpenAI alone could present $150 billion to $200 billion revenue opportunity for Broadcom across multiple years of the build out. So the company is riding a massive trend and is doing really well, and the growth is not going to be stopping anytime soon. So the question is, why is the stock down 13% over the last 5 days after such an amazing report and after all the amazing things I told you? Well, there's a few things around it. One of it is Oracle. Oracle is down 18% on the month. Oracle has a terrible debt situation. It's very dangerous. I did a video going through the company's maturities, debt maturities, and their abilities to repay the debt. And I don't believe they can actually pull it off. And it's really dangerous. But this is a quick highlight where the company has $127 billion in debt. $25 billion is due within 3 years. The company is free cash flow negative, reporting roughly negative $13 billion of a loss over the last 12 months. And it's not expected to be free cash flow positive before 2028. So they are in a very bad situation where they have $127 billion in debt, and they only have a $19 billion cash position against it, and a lot of maturities, and they're going to be losing money over the next 3 years. And this is a really bad setup for the whole AI market in general. But recently, some things have been improving, and it could potentially get better from here. But the second reason was the company's valuation was too extreme. You just cannot justify it by any means. The company's average PE ratio, forward PE, is 22 times. The company was trading at 45 times earnings. That was extremely overvalued. Now trading at 32 times earnings is a little bit better, but 45 times was absolutely ridiculous, and it was priced to perfection, and it was due for a multiple correction, maybe back to the average, or at least 32 times is really not bad versus 45 times. But on a trailing basis, the stock is still trading at 69 times trailing earnings. This is really expensive. Now, we have to admit that it's expensive for a reason, and the reason why it's expensive is because of the massive growth that the company is experiencing, where they're growing 40% in earnings per share. The analysts expect next year to be a 47% earnings per share growth period for AVGO, followed by 36%, followed by 27%. So the growth is not expected to stop anytime soon, and you're not going to be able to buy such a company for 15 or 18 or maybe even 20 times earnings anytime soon. So this is my valuation model on AVGO. I put the current earnings per share for 2025, $6.82. Then I use the analyst estimates of 47% growth, 36%, 25%. Then I took it down to 20 and 20 for a 5-year price target. The current trailing PE is 69 times earnings. The average has been around 25 times, or around 22 times actually. I took it from 69 times earnings to 25 times earnings. I know some of you might believe that could potentially be aggressive, but you have to think about it, that those kind of industries, they go through cycles. And now we are front running a lot of the AI build out. So from now to 2030, a lot of those data centers are going to be front run. They're going to be built in terms of the workload and everything. So if we're front running all the build out of the data centers after 2030, I highly doubt that AVGO will still be growing 25, 35 or 45% earnings per share. It will likely drop down to 15%, maybe 20%, and that warrants a multiple contraction. So I feel 25 PE is fair. On this basis, I'm getting 14% annual return or 89% on the upside. If I want to get a 15% return or double my money over the next 5 years, I would have to buy AVGO at $318 per share. So I believe AVGO is getting fairly valued. It's not extremely undervalued. It's not the bargain of the century. I think it's getting close to fairly valued. For me personally, a price I would consider buying AVGO at would be around $270 to $280, because I still believe those estimates are a little bit optimistic, and maybe the valuation of 25 times earnings 5 years from now, when competition is changing, a lot of things are happening, that could be optimistic as well. If it trades at 22 times earnings as an example, I would have to buy the stock at 280 for me to get it double in 5 years. So for me personally, under 280, I would be very interested. Around the current price, AVGO is not bad. It's fairly valued at best. I see a 14% annual return. I don't believe it's extremely undervalued, and I don't believe it's a bargain of the century, but under 280, it starts to get very interesting. And that's my opinion on AVGO. It was not financial advice, so I hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.